I'm back. I've been in Miami the past couple of days. I'm here today and tomorrow, and then I'm going to be back in the studio. But it's been too long without a video, so we're here to check in before the CPI, talk about what we're seeing, talk about what we're thinking, and how we're preparing to go into CPI, what we're going to do depending on how it comes out. So I expect that CPI will come in hotter than expected. CPI important, but not as important as core CPI. The indicators I've seen suggest that used car prices are up a lot. If you remember, this was a big part of previous CPI and core CPI reports. It might lead to it being hotter than expected again here. Some prices that have come down, food prices have come down, but we know the Fed likes to strip out food and energy from their prices. So I expect that the stuff that has come down won't have such an impact. However, I think a slight boost in energy prices does trickle more into various areas of the economy than people give credit for. So it's only been a slight bump in energy prices, roughly 10% in retail gas, but that's not a decline that we had seen for several months consistently. So that might mean that there's not as big of a decline to come. I'm expecting a hotter than expected CPI report. I think the expectations for CPI are quite low. I'm seeing various forces that are higher than the previous month, that were in decline in the previous month, that are now in acceleration in January versus December. So I'm expecting a hotter than expected CPI. We'll see how it comes in. Regardless, let's talk about where the market is at, because we've seen a pretty big rally here, and I am not liking the current market positioning. Obviously, I've been bearish to start the year, and it's been a painful year for me. There's no doubt about that. It's been a month and a half, and it hasn't been a fun month and a half. It's been a lot of traps and a lot of continued rally. But we are roughly 13.5% away from the all-time high in the S&P 500. This is despite 500 basis points, roughly, soon to be, of Federal Reserve tightening. And I say soon to be and roughly because the market should adjust for what is just going to come in a month from today, basically, 1 month and a few days, not that long. The market should adjust for that imminent rate hike that will bring the Fed funds rate to 5%. Anyways, we're 13.5% off the all-time high. We're at the same level we were in July, actually higher than we were in July, when 5% Fed funds was not something that was really on the table. I mean, we had just kind of gotten over that 75 basis points would be on the table. There was still a lot of bullishness out there for sure. And we've been in a trading range for 8 months now. 8 months. We've just basically been going sideways. However, the Fed funds expectations has gone up for the Fed, the SEP. That was the last SEP. They're publishing another in March. And it sounds to me like they might actually move those projections higher than they had previously had them. So we'll see what happens with that. A lot's going to matter, or a lot's going to depend tomorrow. Tomorrow's a pretty big day for the markets and the economy overall. So it'll be quite interesting. But again, July, we did not have a 5% expected Fed funds rate. We were like, I don't know, I'm assuming, but maybe closer to 4%. Actually, I think it was even lower than 4% because at Jackson Hole, which happened in August, the Fed began to talk about 4% and then later began to talk about 5% and above 5% and higher for longer, et cetera, et cetera, et cetera. So we still have that same stock market, and that's just the Fed side. Then you get into the earnings side. Apple has contracted. They just not only contracted, but came in below expectations. So and this is probably just the start. The Fed has told us and will continue to tell us, and you'll probably hear them tomorrow because there's 3 Fed members at least going to speak. The full effects of the tightening have yet to be felt. And that's the tightening that has been done, not the tightening that they're going to do. And based on what I heard today from Bowman, it sounds like they might do more than 5 to 5.25% in Fed funds. So I think a hawkish Fed is on the table. I think a hotter CPI is on the table. And I think a stock market that has to adjust for a very different picture than we had in July is also on the table. Now, I have been pained in believing this because it's been a tremendous rally to start the year. But these are the fundamentals. all I can do is share with you my fundamental view. What happens in the stock market day to day is impossible to predict with certainty. So I'm doing the best I can with fundamentals. I do look at technicals a little bit. They don't always hold. They don't always, do whatever. They're really just, highly debatable how useful they are. Sometimes they are very useful. Sometimes they aren't useful at all. So you can't really rely on them. The one thing you can rely on, in my opinion, is fundamentals. But as we are learning here, the market can remain irrational longer than you can remain solvent. The thing with buying Apple, their earnings are not going up, it seems. There's no reason for them to do so, and all the fundamentals point to them going down. The last quarter points to them going down. The guidance is nothing too special. However, the stock is trading at a tremendously expensive PE. It's just slightly cheaper than a U.S. Treasury yield, 10-year, which offers certainty in terms of return. So it's priced at the maximum, essentially, that it can possibly be priced, and there's a chance yields go higher. If CPI comes in hot tomorrow, yields will go higher in a split second. So that's today's video. We got to see how tomorrow looks. We will adjust one way or the other, but I'm going into it negatively positioned, short and long energy. And if it comes in lower, I have to evaluate things, and I will probably sell and cover a lot of the shorts, but it will depend on what the Fed says in part as well. So that's today's video, and until next time, peace out.